The Bank of Canada just announced that they're increasing the overnight rate 50 points, so banks will also be increasing their prime rates to reflect this change. Hello everyone, I just want to make a quick video discussing the Bank of Canada rate change that just happened. I'm going to be discussing what this change means for your mortgage payments. I'll also be going over why changes to the overnight rate impacts prime rate pricing. And then I'm going to be giving you my thoughts on fixed versus variable rate mortgages. So as I said before, the Bank of Canada just announced that they're increasing the overnight rate 50 points. And this means that banks are also going to be increasing their prime rate pricing, most likely 50 points as well. So the reason why when the Bank of Canada increases the overnight rate, banks also increase their prime rate is because the overnight rate is the rate that banks actually borrow money. So when that increases, they also have to increase their prime rate to reflect that change. So how does this increase impact you? So if you're in a variable rate mortgage, you'll be impacted by this increase pretty much immediately. If you have a variable rate mortgage with a static payment, your payment isn't going to be changing, but the amortization will be, and the percent that's going towards interest versus principal will be. So since the overnight rate increase, that means more is going to be going towards interest rather than principal, meaning you won't be paying down your mortgage as fast. Now, if you're in an adjustable variable rate mortgage, your payment is going to be going up to reflect this change. So now let's take a look how this change will impact someone who's in a variable rate mortgage with an adjustable payment. So in this first example, we have a $500,000 home with a mortgage amount on it of $494,000. We're amortizing this mortgage over 25 years, and we're using the previous prime rate of 5.45. And for this example, we're going to use a discount on prime of 0.9%. Now, everyone's discount is different. It all depends on what your mortgage terms are. So in this scenario, your payment would have been $2,748. Now, with this increase in prime, with the exact same mortgage details, but now instead your rate is going to be 505. So what I'm doing here is taking the new prime rate of 5.95 and subtracting 0.9% off of it, keeping that same discount, because when prime increases or decreases, your discount always stays the same. So your new net rate would be 5.05%, making your new monthly mortgage payment $2,887. So along with the rate increase, the Bank of Canada also released a press release. So I'm going to be going over that. So the Bank of Canada stated that in Canada, the economy continues to operate in excess demand and labor markets remain tight. The demand for goods and services is still running ahead of the economy's ability to supply them, putting upward pressure on domestic inflation. Businesses continue to report widespread labor shortages, and with the full reopening of the economy, strong demand has led to a sharp raise in the price of services. So along with supply chain restraints we're also seeing a demand issue. This is largely due to high government spending over the pandemic, historic low interest rates that made debt more affordable than ever. And then also during the pandemic, everyone was stuck inside. They weren't able to spend their money. So everyone has an increased amount of disposable income. So the goal of these Bank of Canada interest rate hikes are to squeeze out that demand in our economy. The Bank of Canada also said the bank expects CPI inflation to ease as higher interest rates help rebalance demand and supply, price pressure from global supply distribution fade, and past effects of higher commodity pricing dissipate. CPI inflation is projected to move down to about 3% by the end of 2023 and then return to the 2% target by the end of 2024. So the target range of inflation that the Bank of Canada wants to see is between 1% and 3%. Right now we're at 6.9%, obviously way higher than it should be. So what the Bank of Canada is projecting that with these rate increases and hopefully supply chain issues start to resolve themselves, like the war in Russia and Ukraine, that we see the CPI inflation come down. they're guessing that it's going to come down by the end of 2023 to 3%, and then into 2024 back down to that target range of 2%. Given elevated inflation and inflation expectations, as well as ongoing demand pressure in the economy, the Governing Council expects that the policy interest rate will need to rise further. Future rate increases will be influenced by our assessment of how tight monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding. Quantitative tightening is complementing increase in the policy rate. We are resolute in our commitment to restore price stability for Canadians, and we will continue to take action as required to achieve the 2% inflation target. So based on that statement, it's sounding like you should be expecting more rate increases to come.
No, God! No, God, please, no! 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 No!
How big will these rate increases be? I don't think we'll be seeing a 75 point or even 100 point increase. I'm expecting anywhere between 25 to 50 point increases in the coming rate hikes. I think if there was any plan down the line of the Bank of Canada increasing the overnight rate 75 points or 100 points, they would have done it now instead of down the line. But that all depends on how the economy responds to these rate hikes. So should you stay variable or move to a fixed rate mortgage? If you're one of the people who are really stressed out about rate increases and it's keeping you up at night, just for your well-being, I would suggest locking into a fixed rate mortgage just for that peace of mind. I wouldn't suggest locking into a 5-year fixed rate. If you did want to lock in, maximum two-year fixed rate mortgage, so that when rates do come back down, you won't have to wait out that whole 5-year term to take advantage of lower rates. What do I think is a better option? Me personally, I think we are near the top of the rate hike cycle, and the Bank of Canada even just stated that they're expecting inflation to come back down this next year. So my suggestion would be either stay variable or lock into a short-term fixed rate mortgage so your hands aren't tied to those massive penalties on 5-year fixed rate mortgages. I hope this helped answer some of your questions and inform you about the recent decision that was made. And remember, I have those 3 guides: the refinancing, first-time homebuyer, and you got your offer accepted. Now you need to obtain financing. Those 3 guides are linked in my bio. Make sure to go get those. My calendar link is also in the description below, so if you want to book a call with me, go hit that link below. And if you like this video, like, subscribe, share with a friend or family member to help me grow this channel and reach more Canadians. And thanks for watching.